Hit it.
It's Friday, August 27th, 2021, episode 146. I'm Patrick Sresna.
And I'm Kevin Muir. We continue with our interview-only summer specials, and this week we have a special installment. Patrick and myself take a break and allow previous Market Huddle guest and outstanding economic thinker David Bezic to grab the controls. And David does not disappoint with an absolute terrific interview of the father of MMT and hedge fund legend himself, Warren Mosler. So without further ado, we present David and Warren.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Views or opinions expressed by David in this podcast are entirely his own and do not in any way reflect those of his employer. Now here's David Bezic with Warren Mosler.
Okay, hello Market Huddlers. Welcome to this week's show. I'm David Bezic. I've been a previous guest on the show, and I'm a friend of Kevin's who has kindly asked me to host this week as he's enjoying vacation. I really appreciate the opportunity, and especially so given who today's guest is. It's Warren Mosler, who I personally think is one of the greatest unique and economic and macro thinkers out there. Just a very interesting person with interesting experience and ideas. So hello, Warren. It's great to hear from you again. How are you doing?
Good. Hello, David. Good to be here speaking with you.
Likewise. I know Kevin wishes he could be here as well. He's very excited. He's also very envious, I think. As listeners know, Kevin's a friend of the MMT framework and uses its lens to help in his investment analysis. And for those that don't know, Warren just happens to be the founder and godfather of MMT. So obviously a great guest to have here. So again, great to hear from you, Warren. And I guess even though there is familiarity with Kevin's listeners with MMT, I was thinking it could still be useful to kind of step back and talk about, I guess, first your own personal experience and how you ended up becoming kind of the known as the godfather of MMT and what your personal journey to that point. And then after, maybe we could back up as well and just talk about what MMT is in the kind of elevator speech version where we get a very high level summary of what are some of the main tenets of the framework.
Mm-hmm. Okay, so I was working, started off in banking in 1973 in a small savings bank after I had a BA in economics from University of Connecticut. I started off in engineering and then switched after 2 years because it was too hard for me. Economics was easy, and got my degree and got out. And then in banking, I started off in the loan department, just collecting actually delinquent loans, personal loans in this small savings bank. And then as the vice president was promoted to president, and they asked me to look at the investments. And so I became the investment person at this bank, which had, maybe $5 million worth of investments. It was a very small bank. But I started making contacts with people and started looking at them and started understanding them. And I was interested in them and started developing an understanding of what, on the look back now, you would call monetary operations, how the whole payment system works. And from there, I went to Bankers Trust in New York in 1970. I went to Bezic in Hartford first, and then to Bankers Trust in New York in 1976, where I was on the money desk there, which is, I'd say, where I developed a much more complete understanding of what was going on in the money markets, with the Federal Reserve, with the banks, with the clearing system, with the entire payment system, both domestic and international. Just in the normal course of business, with our buying and selling of securities, and trying to analyze the news and trying to analyze Fed policy. It just developed into an ongoing conversation that is all based on monetary operations, which is the essence of modern monetary theory. It became more of a body of, something that started developing in the early 1990s, and it happened to be coincidental with what's called the Italian trade, but it's when Italy was facing a default. The academic economists had all written papers, guys like Rudy Dornbusch, how Italy was going to default, and their securities were trading at a discount. You could borrow lira, and you could buy that maybe 10%, and you could buy lira-denominated government securities, their Italian government securities, at 12%. So you would make a free 2% if Italy did not default, and it was an expression of default risk. So that got me thinking about, why a country would or would not default, could or could not default. And the revelation that I think is now at the core of MMT, and for the elevator speech, if you understand this, you've got a big head start into the big change that MMT has made to policy, and that is sequence. Up until that time, all thinking, all mainstream models, all discussion implied or understood that the government had to get money first through taxes, presumably, before it could spend. And every congressman, every member of parliament, they understood they had to somehow get money in before they could spend it. And what they couldn't get in taxes, they would have to go out and borrow. And in the U.S., the metaphor is you borrow from China and leave the debt to our children. And that sequence is pervasive. There was no one questioned that sequence. All the mainstream models that had G minus T equals this and that, the presumption was that the government would take in through taxing or borrowing, the funds that it was going to spend. Okay. Now, modern monetary theory turns all that around with the understanding that that's entirely backwards. That the government, through its agents, the Federal Reserve, one way or another, is the source of the dollars that are used to pay taxes. They don't come from the private sector. They come from the government. All the dollars that can be used to pay taxes come from the government through its agents, generally the Federal Reserve. And therefore, since all the dollars to pay taxes, all the dollars that can buy government bonds originate with the government, then the government is actually, under close examination, spending first, and then some gets paid in taxes, and then the rest is used to buy bonds. Well, once you see the sequence the right way around, that way, then you realize the idea of running out of money or solvency or turning into Greece or anything like that is entirely inapplicable. It's inapplicable for a government that spends first, must spend first because it's the source. Look, nobody thinks that the movie theater has to collect the tickets first and then sell them. But that's exactly what they were thinking about the federal government, that somehow it would have to get dollars first before it could spend it, when in fact it was the source. So I don't want to belabor this, but I think that is the key understanding of modern monetary theory. And what we do is I tell a money story. And it's not the money story you read in the textbooks about how there might have been barter or something happened on a desert island or there was this need for money to help facilitate trade or anything like that. The MMT money story begins with a state, a government that wants to provision itself. And so you have a government that wants a military, it wants a legal system, it wants public health. And how does it provision itself? What does it do? And so the very first thing the first thing in this sequence is you begin with a state that wants to provision itself. Number two is the state imposes a tax liability. It doesn't collect tax to get money. It imposes a tax liability. It puts a tax liability on everybody's home, for example, that says you owe X amount of dollars. So first comes the need to provision a government. This is followed by a tax liability that suddenly causes everybody to need, in the case of the United States, U.S. dollars, in the case of Canada, Canadian dollars, et cetera, to need what the government is demanding for tax payment. And that need is expressed by people looking to sell goods and services, looking to get jobs, looking to sell their tomatoes to get the dollars needed to pay taxes. Right? And so number one, the state wants to provision itself. Number two, it imposes tax liabilities. Number three, these tax liabilities create sellers of goods and services who want the state's tax credit, which is what the dollar is, the thing needed to pay taxes, in return. It's number four, the state can now purchase the goods and services it wants. It can now hire people for the military or for the public health system or buy food for its cafeteria from these people who are sellers because they either directly or indirectly need or want the money to pay the tax. Okay. After the government spends, now these people have the money to pay the tax. And let's say that cycle is over. That ends the cycle. So the last part of the cycle is that the taxes get paid. Now, invariably, people will earn more than enough just to pay taxes because they want to save some. They want some dollars in their pockets, or they want them in their pension fund or something else, or merchants want them in the cash register. You have a money supply in an economy, and that money supply are the dollars spent by the government that haven't yet been used to pay taxes. The government buys things from people who are willing sellers. They want the money to pay taxes and to save. And that savings is what we call the public debt. Now, I don't want to go too far with this, but the key takeaway has to be that the sequence is backwards. The mainstream sequence that's been understood and that's been driving policy is backwards. And so you get all these like inapplicable discussions about budgets and whatnot that MMT totally overturns.
Thanks. That's a great summary. There's a lot of things in there that I'm going to want to come back to at some point. Hopefully we get the chance. But I guess going from that high level and then kind of, I guess, applying it more to your experience trading or looking out at the investment world, how did you go from those kind of concepts to applying it? So I know you mentioned the Italy example, but thinking kind of more the experience at III, just kind of more, the day-to-day, what were some of the things you were looking at that helped kind of, I guess, eventually get you to some of the ideas I think that you had in soft currency economics, and then eventually later in the Deadly Frauds book, which I highly recommend to everybody. So was it when it came to, say, the trading aspect or looking at counterparties, were there certain events or things that really jumped out at you that made you think, okay, the stuff I learned in economics formal training doesn't apply here? And
well, not too long ago, we had the U.S. debt ceiling crisis under President Obama, which everyone had wrong. There was a document 4 inches thick about why this was going to drive up interest rates. And of course, we were saying that no, it's the opposite. It's going to drive rates down, not up. And that, the government was not. Look, you have to sell. What you do is you understand the difference between ability to pay and willingness to pay. So the U.S. government always has the ability to pay, but you don't know if it's going to have the willingness to pay. You don't know if Congress is going to honor its bills. You could work for the government and they owe you a salary, and they certainly have the ability to pay. They just credit your account at your bank's account at the Federal Reserve, and for further credit to your account. It's a simple markup on their computer. So they always have the ability to pay, but you don't know if somebody in Congress is going to decide not to pay you. And so we recognized early on that distinction, and it's a distinction the rating agencies sort of had in there, but didn't apply. And so they would downgrade the United States based on its ability to pay, not its willingness to pay. Or they would downgrade Japan, I remember, long before that. And the idea was, it wouldn't have the ability to pay because the public debt had got up to 200% of GDP or something like that. And, I knew that Japan always had the ability to pay and had full intentions to pay. And there was not and had every motivation to pay, because not paying had much worse consequences than paying. So why not just credit the account? And so we would not make the bet that a lot of people did, that Japan was going to have credit problems, that interest rates were going to go higher, but instead understood it the other way, that there was not going to be any kind of a solvency problem in Japan. On the other hand, when the euro started, the European member nations no longer had the ability to pay. They were no longer spending first and then taxes were paid or bonds purchased. That whole status shifted to the European Central Bank. The European Central Bank was the entity that mirrored our Federal Reserve. The European Union, all those member nations, turned themselves into what are like U.S. states. And as we know, U.S. states like California, Massachusetts, any state can get themselves in a financial bind, get themselves in a liquidity crisis, and need some kind of a bailout. And so Europe had done that to themselves, only much worse, orders of magnitude worse than in the United States, without going into too many details. And we were I think I was one of the first to recognize that. It was back in 1995, before the currencies were even locked, back when they were discussing it. I was going like, this is absurdity. This is like entirely dysfunctional. And the channel I identified even back then was the banking system. You can't have deposit insurance by a government that doesn't have, its own currency, doesn't have the ability to pay the way, the U.S. does. For the FDIC we offer FDIC deposit insurance, but it's guaranteed by the federal government. The deposit insurance in the European Union was going to be guaranteed by the individual nations and not by the European Central Bank. So that was like setting up deposit insurance in the U.S., where Bank of America would be insured by California and Citibank would be insured by New York, which, entities which don't have the financial capacity to do that. And so this was like a massive global accident waiting to happen. Now, it took a while. It took, and I pointed out that it would take a catalyst to do this, and it was the financial crisis of '08 that spilled over into the European Union and challenged it, and it all came apart. And it was only saved by, exactly what we had said was going to save it, because there's no other choice. It was saved by the European Central Bank, Mario Draghi, saying, we will do what it takes to prevent default, which means central bank guarantee. And then that whole solvency issue went away. And that simple proclamation turned them more into something like the U.S. and Canada, so it could continue to function.
Mm-hmm. I really like this example because when the crisis was happening in Europe, I was working at an institutional investor here in Toronto, and I remember at some point sending to my boss a description that you had written on the European crisis and basically how it was baked in the cake because of the institutional structure. And I sent it to my boss, and it read as if it was describing what was happening exactly at that point in time. And then I pointed out to him that it had been written about 10 years earlier. So it was, it was a very, it was, I think, a great call. And I think I want to ask you about Europe, because I feel like you've nailed it. Like, it's from day one, basically, from even before it existed, the fact that a crisis was baked in the cake, the Draghi game changer. On that one too, I remember the day he announced it, and then the OMT, the open market or outright monetary transactions or market transactions. I can't recall exactly, but the OMT, I remember in a meeting that morning and people saying, "Oh, this is just another acronym from the ECB, just part of the alphabet soup." And then based on the stuff you had been saying, I was saying like, no, this is a game changer. This is really changing the actual institutional structure. And then as we see now, looking back at charts, it was pretty much to the day that the peripheral spread started coming in. But I'm curious, and you had been one of the early ones talking about Eurobonds, and basically they have to come because there's no other choice. Otherwise, the Eurozone can't survive in its current structure. And so now it seems like we're going down that road as well. So I'm curious, what do you think? Do you think Europe is going down the right road with the talk of Eurobonds, the recovery fund? So A, do you think it's going down the right road? B, do you think they're going to get it right? And how long do you think it'll take?
So I think they understand now that there's no solvency issue, involved if they with deficit spending, and that they guarantee all the member states that they don't have to worry about markets anymore. So they know they don't have the markets to look at and say, well, we can't do this because the markets won't let us. So they understand that the markets are not applicable to their political decisions. The remaining situation I see is who makes the fiscal decisions in the European Union right now. And I see it as the only place in the world where they're made by this central bank, and in a very peculiar, almost awkward fashion, where the central bank has the they've got this do what it takes umbrella that all the to prevent default umbrella that all the member nations are under this umbrella. So as long as you behave and do what the central bank tells you, you can fund yourself at 0% or whatever. I guess even Greece is negative rates now. But if you step out of line and the central bank makes noises to say, look, we're going to pull this umbrella away and you're going to be on your own, then your spreads shoot out, your rates shoot up, and you're facing insolvency as a nation. So they have this weapon over the member nations, this enforcement technique. And so they dictate whether or not these nations are in compliance with their idea of fiscal responsibility, whatever it is. So if they determine that we need 10% GDP deficits like they did last year, and these nations do it, fine. There's no solvency issue. If they determine that it's got to be 5 and the other nations just want to do 10, they can't do it. They'll be cut off from the ECB. So you've got the ECB deciding whether or not, what fiscal policy should be throughout the European Union. And the other entities, if you want to call them that might have been the ones to do that. For example, there's the Maastricht Treaty, had the 3% limit. Well, they figured out a way to overrule that. But it wasn't like the finance ministers, right? And it wasn't it wasn't a European Parliament. And if you look at which entities were allowed to do this kind of thing or what you have to do to change the treaties, none of it said, it's up to the ECB. So none of the political channels written into the documentation have been honored, and nobody cares. The people who maybe should have responsibility, maybe it's the finance ministers or ECOFIN or whatever, they got all these different committees over there that specialize in $1,000 plate lunches at public expense, right? They're perfectly happy to see the ECB doing it, and they just stay out of the way. So it's a pretty interesting situation. It's absolute, it's sort of a dictatorship of the ECB. The chairmanship moves around a little bit, and I guess it's if the policies they come up with are acceptable to the member nations, then it'll continue to go along like it is and continue to exist. But if it's not, they don't have any way to change this. They don't have any way to alter these ECB decisions. There's no there are no political channels, and so except to do what the UK did, which is leave. Mm-hmm. So you either follow the ECB or you leave. It's kind of an interesting phenomenon. I don't know how long it's going to continue like this, but it's been doing this for 10 years now.
Yeah, and it feels like it's just they make progress, but it requires a mini crisis or something every time to take the next step. And so I wonder about the time frame too. I feel personally like they're going down the right road, but it's a painful, slow process. And is it going to get there before it matters to any of us alive here today? So I guess
what you realize is how much a population can stand without going into open revolt. Look at what happened to Greece. They went along with it. The people went along with it. There was no open revolt. There were some early on protests, but it disappeared, not because things got better, just because they just decided to soldier on with what they have. So, yeah.
And I know you've spent a lot of time in Italy and speaking with policymakers there and I guess people involved in politics. What's your read on Italy in terms of the future and the appetite for Europe? And it seemed like things were getting a bit trickier a couple of years ago, but it seems to have stabilized again. What just based on your personal experience in Italy and people you talk to there, what do you think? What do you think about the outlook there?
They've got a pretty strong group, or a pretty well-educated group of what used to be called MMT activists over there, and they're economists. They're PhDs now. They've matured. They're very bright. They're have a good sense of public purpose, and they're involved with pretty much all the political parties now with their economic policies. So they understand where they would like to go and what needs to be done to get us from here to there, whether it's as a member of the European Union or outside of the European Union. And so the problem is not knowledge of monetary operations or knowledge of the system or what it takes to get the European Union to real full employment and real prosperity. They know that. There's an interesting problem, which is these used to be their own countries. What to me seems not that long ago, because I used to be involved with lira and pesetas and krona, all these other currencies that are no longer there. And to me, that's like just yesterday. But it's not just yesterday anymore. It's 25 years ago. So if you've got anybody, 40 years old, they were 15 when it changed. They don't have any memory of national identity like that, national currencies. It's all like way back in the past, and even older than that. It's way back in the past, and so they see themselves as so. For example, there was a time in the U.S. when the states were, individual countries, really individual entities. They were independent, and then they got together and formed the United States. So right now, if we have a crisis, if things are bad, you don't see Florida saying, we need to leave the union and start our own currency, or Texas, we're going to leave and start our own currency. You don't see it from any of the states. It's not even part of the discussion because, at one time, Massachusetts had their own currency, right? But it's all gone from the institutional memory. It's all gone, because it was 200 years ago or whatever. But it's getting far enough away from that in Europe now where these ideas that, I'm 72 this year. You're not that old, but you're old enough to remember the currencies. It's fading, and with time, it's less and less likely to happen. And the other thing is these governments, like the Italian Parliament, used to be the Parliament of the Italian government, which had a foreign policy and which was involved in wars and which was involved in nuclear discussions and all of this type of thing. And now it's not. Okay, and now they're just like New York or California, where it's all local politics. These politicians are no longer relevant in the world, on the world stage at all. And Germany, right? It's just a state. And like Texas used to be relevant. They had their own country. They fought a war with Mexico. All of a sudden, they're part of the United States. That's all gone. So our state legislatures have adapted to this, to their status. In Europe, they're still struggling with it. But with every passing year, they become more and more like our state governments and less like our federal government. And yet the European Parliament, which is like our Congress, doesn't have the authority, doesn't make real laws or anything like that I can tell. And there's no process for them to have the legal clout that our Congress has. Mm-hmm. So Europe's kind of left without a presence in the world. Mm-hmm. If there's a problem in, I don't know, North Korea, nobody cares much what Europe thinks.
Yeah.
they're not even, they're there with a G whatever, but they're they're kind of vestigial.
Yeah.
And they're because of their, what brings to mind the Articles of the Confederation after the U.S. was first formed. We had the same problems and with currency and everything else. And then it turned into the U.S. Constitution, which unified it as a country, put the taxing authority up at the federal government level rather than trying to collect money from the individual members. And it changed, the U.S., profoundly. And Europe hasn't gone through that change yet, and it may never do it. It may just stay just a loose conglomeration of where none of them have any kind of, certainly military power or military presence or any kind of a, global political status. And so the issues that come up in these elections are local issues, mm-hmm. and rather than international issues, because they're not international anymore. And the issues that come up to the European Parliament aren't anything because they don't do anything. So I've seen people running for European Parliament. None of them have foreign policy, proposals or anything like that. It's kind of interesting the way it's been diffused, let's say. Yeah. Which, of course, look, back when it first started, I remember in the 80s and 90s, the big idea was to put something together to avoid World War III. And they've done exactly that. Now, mm-hmm. whether or not how beneficial it's been socially, they haven't been in a war. It's for a very long period of time. And if you look at the histories of these countries, they were a continuous war for 1,000 years. And that's all come to an end. So I think certainly on that level, it's been a resounding success. And hopefully on that level, it continues to be a success. But like we just mentioned, the economics are questionable right now. Yeah. And we don't see the channel to fix them, except, very slow, gradual over a long period of time.
Well, I think this is an interesting, I guess, potential segue, but I feel like that institutional structure and what MMT informs on that structure gets into this idea, and Kevin's talked a fair amount about it, of MMT having a descriptive element and a prescriptive element. And I think a lot of the stuff we're talking about now with Europe, as you start getting into the policy realm, it falls under that prescriptive stuff and what is and what's not possible. So I guess on that descriptive piece, I think, and I'm speaking for Kevin here, but I just based on what he does and what he's interested in, I feel like a lot of it, his focus is on the descriptive piece, and to the extent it is on prescriptive and what policy outcomes might come out of through the MMT lens, you can get a better feel for what the market implications may or may not be. But that descriptive piece I find particularly interesting because it's not, you're just describing the world as it exists.
Yeah.
And I think MMT does it in a far more accurate way than my textbook certainly did. And yet somehow MMT is labeled as a controversial framework, or, I just find that interesting that just because it's describing the world as it actually exists and, is consistent with data, empirical observation, that is somehow deemed controversial.
I think what they're doing is they're confusing a prescription with a base case for analysis. So I have what I call my base case for analysis, which is a money story I talked to you about. Government wants to provision itself. So it levies a tax, creates people unemployed, right? Taxation is the cause of unemployment, creates people looking for paid work who can't find it until the government spends, either hiring them directly or indirectly through private sector spending. And then after that, taxes get paid. Now, and then you find yourself with this residual unemployment because the government didn't hire all the people that its tax liability caused to become unemployed. So in the United States, the tax liability may have caused 20 million people to become unemployed. We've only hired 5 or 6 million. So what about the other 14 million? Well, they are there because the tax liability created them as a point of logic. So in my base case for analysis, I'm saying, okay, well, base case, what do we do at this point in time? Well, we either cut taxes or increase public spending until the unemployed all have jobs. And we have to decide whether we want them in the public sector or the private sector. So maybe we hire some for the public sector, and the rest we want to cut taxes so there's more aggregate demand so the private sector will hire them, except the unemployed are damaged goods for the private sector. They want to hire people already working. And, like every study shows that. So how do you get these people into the private sector? We have what's called the job guarantee, which used to be employer of last resort. The acronyms have changed over the years. But you offer a job to anybody willing and able to work. And I call it a transition job because the purpose of this job is to promote the transition from unemployment back to the private sector, to make up for the wrong that the government created by, its tax liabilities creating more unemployed people than it wanted to hire. It's a calculation error. So anyway, I've got a job guarantee in my base case for analysis. Now, is that a prescription for an economy? No. It's a base case for analysis. I also have, if you notice in this example, it describes a zero rate policy because there are no government securities and there's no interest on reserves. So in my base case for analysis, I have a permanent zero rate policy. Is this a prescription? No. It's in the base case for analysis. And if you look at the currencies we've created, the UMKC Buckaroo, the Denison dollar, the Franklin franc at the various universities, they all start with this base case for analysis. And then if you want to do something different, fine, make your case. And if it makes sense, go ahead and try it. So if you decide, okay, the private sector will hire people who are unemployed just as easily, whether they're in a transition job or not, and we don't care whether these people are working or not, let them be desperate, or let's pay them unemployment insurance. Fine, you can deviate. That's what a base case of analysis is. It's a starting point. If you don't think the zero rate policy should be there, you can pay interest on reserves or sell securities and have a positive rate policy. So anyway, I've got this base case for analysis out there, and it's turned into a prescription by some of the critics. and who've just entirely missed the point, the difference between the two.
Mm-hmm. Yeah, I agree. Well, that's my perception as well.
Yeah.
And for what I do, I have an appreciation for both, but it's that descriptive piece that in my day to day really, I guess, is what I focus on, and it's my lens for a lot of analysis.
Yeah.
And when it comes to that descriptive piece, I guess it relates to a question I was going to have about like who are MMTers, and when we think of who are the big MMT names? Obviously, you and Stephanie Kelton, Bill Mitchell, Randy Ray, and these are the people and names that are in the spotlight. But my perception is there's many other MMTers in spirit, if not necessarily in name. And I guess what I mean by that is it's people that share a common view on that descriptive piece. So I'm curious if you've kind of encountered that as well. And I guess what I'm thinking of there is, people whose job requires them to get these descriptive elements right. So I find, often it's people that are short-term interest rate traders because they're really into they're at the coal face of a lot of the operational stuff with Fed, bank, treasury nexus. Portfolio managers, Fed staff, bank balance sheet managers. A lot of those kind of people, I feel, share a lot of MMT's descriptive elements. And it's not because they're saying I'm an MMTer necessarily. It's just I'm trying to explain the world. MMTers trying to explain those same parts of the world, and they're just landing on the same page. So I'm thinking of even people like, you get, I don't know about talking about specific names, but I guess Paul McCauley, like he said, he's not a card-carrying MMT member. And for listeners don't recall, McCauley was the.
I've never spoken to the guy.
No,
I've tried, and he just won't do it. He won't engage.
No, okay.
So he's just got his own ideas. But there are a lot of people like that who've done a lot of positive things to promote MMT, even though what they say isn't maybe right. Let's say some of it's just plain wrong. Yeah. But without them, it wouldn't be where it is. So I kind of use the word herding cats. Yeah, they're just going all over the place.
I find a lot of those people. So I don't know about Paul McCauley specifically, but he has said he's a friend of MMT, and he's presented on MMT-ish ideas, I think, at one of the Levy conferences. And there are people like Charles Goodhart. The things they say, whether it's the idea that we don't live in a world of fixed loanable funds, endogenous money, no money multiplier, like these sorts of things. Mm-hmm. It just comes out in their jobs or their analysis. And I find a big part of my job is consuming research, and there's a lot of it. And so one of my first steps is to just find people that share those kind of views, even if they don't consider themselves MMTers. And it's not because I'm trying to, it's not like I'm trying to say I'm on this team and I'll only listen to people on this team. It's my job, again, is to try and get it right. And I want to be listening to people that are looking at the same map, I guess. So what analogy I have is, if I believe the world is round and someone else believes it's flat, and we're trying to get, from Europe to China by water, I'm going to want to listen to other people that also believe the world is round. And, we might come up with different views of what's the best way to do it, or, is it going to be good weather, bad weather, or whatever, but at least we're talking from the same playbook. So I find this kind of, I guess there's a question in here somewhere, but it's, in your experience, do you find that there are these people that are, if not MMT in name, at least in spirit, and share a lot of similar ideas? Yeah,
because I remember going to your speaking in front of your organization, and one of the members there was former Bank of Canada, right?
Yeah,
and correct. He was entirely supportive on all the monetary operations side, and it went without saying. Of course, that's how it works. But they also know that a lot of people get it wrong, but for some reason they're not on any kind of a crusade to educate them. But that's a different story. But you get a group of people. We just talk of monetary operations. It's no big deal. It's not MMT. It's not anything else.
Yeah.
And the MMT never comes up. I didn't come up with the name MMT. Somebody else did and started calling it that.
Well, and I find it interesting too, because again, it's kind of, there's nothing controversial there. Again, just describing the operations, whether, it's someone who's been at the Bank of Canada for years and so I think MMT, when you read about it or hear about it, often it's, again, going back to that prescriptive piece.
Mm-hmm.
But the descriptive piece, unless, I think that's where people should try and spend more time if they want to criticize MMT, or try, come up with kind of areas to poke on.
Mm-hmm.
Unless you can say why the world we live in is not the way MMTers say it is, and I feel like you can't really you can't really criticize beyond that. Like, that should be the starting point, and there's nothing controversial there in my perception, again, because you hear it from people that are deep into those trenches, and they say
Mm-hmm.
they have the same description. So,
well, the other thing is, you get a undergrad who's taken a couple of courses in MMT, or from a professor who teaches monetary operations the correct way around money and banking, and he gets it, and then he writes a piece saying, "This is what MMT is. These are the 5 key things to take away." And then some critic of MMT looks at that and says, "Oh, look, MMT is wrong. Here's what it says: these 5 things, and number 3 isn't right," or something like that.
mm-hmm.
It's like, okay, this was written by an undergrad who took a course, right?
Mm-hmm.
So there isn't anybody you can go to except me, sort of, that you can criticize and then say and have that mean that MMT is wrong.
Mm-hmm.
Okay, because all the other proponents are, they've got things in there that can be criticized.
Mm-hmm.
They've got things in there that I've criticized, or certainly work with to try and correct some things they've got in there. They've got ambiguities in them. You've got all these people going out saying taxes don't fund spending. Well, that's a little bit disingenuous, because clearly tax liabilities are the first thing that happens before a government can spend. You can't spend a tax credit unless there's a tax liability out there. Without a tax liability, a tax credit doesn't have any value to anybody. So when they use the word taxes, okay, does that mean tax liabilities, or does that mean the actual funds, right? And so they won't clarify. They won't say taxes don't fund spending. It's tax liabilities that facilitate spending. They'd say it that way, then you don't get the pushback that's been going on out there.
Mm-hmm.
Or therefore you don't need any taxes, and all this other stuff. But that's how they say it. And they're not technically wrong, because under their definition, they mean tax revenues, right?
Mm-hmm.
And the way I've said it from the beginning is that the government is not revenue constrained, and nobody takes issue with that. Who looks at it would say, okay, that's wrong. I say you need tax liabilities to facilitate spending, and then the government spends by crediting accounts, and so there's no revenue constraint. The constraint is on what is offered for sale. If anything's is for sale with a dollar price tag, then the Fed those can be bought by the government, the U.S. government. If it's got a Canadian dollar price tag, it can be bought by the Canadian government. If it's got a yen price tag, it can be bought by the Japanese government. And their own local taxes create goods and services with those price tags on them. Okay, well, that's not particularly controversial, and it doesn't create the same kind of discussions and the same kind of criticisms of just saying taxes don't fund spending. And so, or this country is not monetarily sovereign, so the rules don't apply. It's like, what rules? What are you talking about?
Mm-hmm.
Yeah, all the rules apply to any currency issue, any currency. There's certain MMT has a framework for analysis for any currency, and the concept of monetary sovereign doesn't come into it. I've never used that as a way to describe anything, because I don't think it's descriptive. I think it asks more questions than it answers. It's easier just to describe what you want, or else to say, oh, the government spends money into circulation. Well, how are you defining money?
Mm-hmm.
Look at all the monetary aggregates out there. Is it one of those? Well, no, it's this. I mean this. Okay, so why don't you just say that? Why don't you just say it creates bank deposits instead of creates money? Then you won't get this argument from people who have a different conception of what money is, or
Mm-hmm.
wonder what you're talking about creating money. Does that include open lines of credit on credit cards?
Mm-hmm.
You can't use so they put these casual terms in a description, and it becomes controversial.
Yeah.
And a lot of times it's at best misleading and makes it more difficult. But at the same time, without people doing that, I don't think the awareness would be anywhere near where it was. That old Borscht joke from the Catskills about, doctor, or it's my brother, he thinks he's a chicken. And the doctor says, have you told him? He goes, no, I haven't told him. He goes, doctor says, why not? He says, well, because we need the eggs. So we need the eggs here. We need the publicity that comes from all this to be able to get the awareness across. And so, we're not out condemning these people for thinking that they're chickens, right?
Yeah. Well, that's funny. This joke's making me hungry.
Yeah.
Yeah, it is. I was going to add this. I have a bunch of other questions, but just you mentioning, getting the word out there.
Yeah.
I'm curious what your motivation is for kind of, spreading the word. Is it like an idea of making the world a better place and seeing the potential that's there and not taking advantage of it? Is it, I guess, just kind of knowing, it's kind of frustrating to see shoddy analysis, shoddy ideas, and you just want to point out where that's happening. And I'm asking too because I remember the first time we actually got in touch, I had asked our co-op at my old job just to reach out to your organization just to see if you're going to be at any conferences coming up, and we could maybe plan around it and try and get to one. And you wrote back personally to the co-op student saying, no current plans, but I'd be more than happy to come up there and talk to you guys in person. And your only condition was that we help find you a tennis partner for your time up here. But I thought that was very admirable, and I'm just curious kind of what's the motivating factor? Is it, again, spread the word, just enjoy talking about this stuff? Because I really noticed it then.
It's entirely just a matter of conscience, where I know I've got information that's enormous public service that ends unemployment, cures cancer, does everything else that's been a policy goal forever, and just as a matter of conscience, I feel compelled to make a good faith effort to get it out there so I can sleep at nights, feeling good about what I've done.
Mm-hmm. Well, this goes back to in the intro. I said you're just an all-around good guy. It's things like that. And it is. I'm not just saying this. I feel like, given there's all sorts of characters in this industry, and they span the range, and it's nice to see someone with your success and it just being as down to earth as you are. And I'm speaking from personal experience, personal conversations, and I think it's great.
I appreciate that.
So it's kind of going back to this descriptive versus prescriptive piece. And again, I think a lot of the descriptive stuff should not be contentious. And when I'm thinking about that, I'm thinking about things again like, the money multiplier is a myth. And you have the Bank of England itself writing papers saying that. You have people at the Fed, like when Seth Carpenter was there, writing stuff like that. Claudio Borio at the BIS saying these things, or banks themselves saying no, we don't lend reserves. And there's all this, it's not just MMTers or post-Keynesians or, people in the trenches saying these things. You have all these official institutions, the banks themselves, and yet somehow it just does not click with so many people. And I'm curious what you think why that is. Again, when you have people telling you this straight from the source, and then the next day I'll get a report saying the complete opposite or something again. And I'm just curious what you think prevents people's minds from opening up and going there.
We had 200 years of maybe not 200 years, but maybe more of fixed exchange rate policies. And we still do for Bulgaria and Hong Kong, but most of the world's floating exchange rates. And all this stuff comes from fixed exchange rate analysis. which is part of modern monetary theory. We tell you exactly how fixed exchange rates work. And, so when I had that debate with Robert Murphy, the Austrian guy, and he started talking about interest rates, the first thing I said was, look, you talk to any foreign exchange trader, if you short the Hong Kong dollar, interest rates go up. If you short the yen, the currency goes down. We have two different exchange rate regimes with two totally different, events happening here for this same thing, for getting short 3 months forward. So, and what the Austrians were talking about, and Murphy was talking about, was applicable to fixed exchange rate regimes where you have a market rate of interest. And if you deviate from that, you'll get what they would call malinvestment, the whole thing. But the U.S. is floating exchange rate, and so are pretty much all the countries in the world, except a couple of. And so, what I was talking about was the United States, where we have a floating exchange rate policy. So I think a lot of this stuff about loanable funds and that it is applicable to fixed exchange rates. Mm-hmm. So I'd have to say that's where they're getting it from. And there were years, hundreds of years of textbooks written about fixed exchange rate policy, including Keynes. The context of Keynes was fixed exchange rates. Now, he didn't like them, called the gold standard a barbarous relic, but that's what it was. And that's what was driving interest rates, investment, savings, all those other types of things, and was putting real constraints on governments while they were on the gold standard. Now, whenever they didn't want the constraints, they'd suspend it, but that's another matter. So you have to almost go back before the fixed exchange rate days to find anything written that would be what we call today floating exchange rates. Mm-hmm. So I kind of fall back on that when people ask me that question about why it is, and it's just an anachronism to the days of fixed exchange rates.
When I was on Kevin's show my first time, I don't know what we were talking about. I think it was kind of a similar question. And at the time, I remember thinking I have to feel like it relates to fixed exchange rates in the sense, if you're applying personal experience to, it's hard to, we all face kind of real constraints on a personal or household level that currency issuers don't. So is that inability to kind of separate your personal experience from someone that has obviously different constraints. But for me personally, one thing that I found was admitting to myself that I was wrong for years. Mm-hmm. And particularly when you're writing stuff or sharing ideas publicly, I think it's really hard to then kind of think, and admit like, oh crap, I said all these things for those years and now I got to change. And it also takes work to change. I think that's another part of it. But I guess on that too, I'm curious if you found, I keep going back to this like MMTers in spirit, if not necessarily in name. I've found that there's people that you can kind of pick up in their writing that they're coming from that framework, or at least consistent, but not coming completely right out because of career risk possibly, or, not wanting to rock the boat. And I'm thinking of one particular example, and I'm bringing it up because it involves you actually. Is on my last trip in my previous employer, I organized a trip to New York where we were going to meet a bunch of what I thought were particularly interesting analysts or just people at sell-side boutique firms. And then we also had a lunch with you. And then from the lunch, I went to one of the big broker dealers, probably about as big as you can get down there. And then I set up the meeting because just based on their writing, I thought, we're on the similar kind of playbook, at least when it comes to the way reserves work and all that. And then as he started talking more and more, because he'd never really come right out and said it in writing, I basically just said, this is like MMT stuff. And he's like, oh yeah. He said, I've been following it for years. And this person's quite senior at one of these big firms. And then I asked, like, what's it like when clients ask about it? He's like, oh, I love it because MMT has an answer for everything, for all their questions. And then he also said, oh, yeah, we've been talking to Warren for years. We actually just tried to get him for a lunch today. And I said, oh, we just came from the lunch with him. He's like, oh, you guys got him. But yeah, so they were trying to get you for a lunch for clients. But it's kind of something that seems to happen more behind the scenes.
Where was this in?
It was in New York.
Oh, in New York? Uh-huh.
Yeah. and he's like, "Oh, you guys got him."
Yeah.
But it's the kind of thing where and I'm curious because this directly relates to you, where it's more behind the scenes, and then the stuff that they were willing to talk about in person, face to face, was quite different than some of the things they were writing.
Well, look, I've always been like full disclosure type. When I ran my fund, everybody, the street, they knew what my positions were. I didn't keep anything secret, and they're not like that. They're very guarded. When it comes to that type of thing, and so it's just a philosophical difference. But yeah, when the credit people would come down to look at us for lines of credit, they'd start off by saying, we have a Chinese wall in the firm, where you don't have to worry about us looking at your positions. We're not going to tell our traders. And I would say, please do. Okay, because if I've got something wrong with one of my positions, I want to know about it because I'm going to lose money. And so look at the positions, check them with your trader, make sure he thinks they're a good idea. If he doesn't like them, let me know right away, please, because you don't want to make loans for bad positions, and I don't want to have bad positions. So I just had a different approach to the whole thing than they did.
Mm-hmm. And I will point out too, this was more on like a research side, not necessarily directly related to trades, but
I ran a fixed income fund, III, from inception in 1982. I started it, and then turned it over to my partners at the end of 1997. And that doesn't matter anymore. Now, we had about over maybe $3.5 billion under management when I turned it over, which back then was a lot. Today, it's not a big deal. But and we were for 15 years, we didn't have a losing trade. We had the highest alpha. I think it was over 6% of any fixed income fund in the world. We used to be rated number one on managed account reports. But again, the whole monetary operation understanding, kept us from losing trades, I'd say, more than it got us into winning trades, which is equally important.
Well, I know the reputation of III in the industry it continues to this day, and often when I talk about you or your ideas, I find people are either they know you from the MMT-ish kind of headliney stories, and then there's another group where, because of where I work in my career, is they kind of know like you as the III guy or the AVM guy, and I find it interesting when you have these two different groups. I guess it goes to the descriptive, prescriptive, and the first group kind of being more interested in the prescriptive stuff, and then that second group more in the descriptive stuff. But it's quite interesting. If you're good, I have a couple of questions that stick to this, the more market-oriented stuff, and curious to hear your views on, I guess, some of the stuff going on in the world currently.
Okay.
So one, I guess, and we've probably touched on it a bit already, and when we're talking about the operational stuff, but when it comes to yields, treasury yields specifically, these are questions I get as well. So I'm kind of asking for my own. I'm curious to hear your response to questions that I get too, and the role played by supply. I'm pretty sure I already know what you're going to say. So whether it's the size of the deficit or the role of QE and QT. And then I guess tied to that is this narrative of a safe asset shortage and price insensitive demand, whether it's regulatory, liability hedging. What role do you see that playing in determining yields? And then I guess just supply from deficits, and then the breakout of that stuff versus expectations of future Fed policy and response to growth and inflation.
Well, let me start with just a macro background. It goes back to somebody was just telling me, they were talking to me back in 1990 or 1980s about how I was talking about that, they got the interest rate thing backwards, that raising rates actually promotes inflation. It's expansionary, through interest income channels and forward pricing channels. So it's been a long time. And I wrote that paper with Matt Forstater in 1997. I used to like to use academics to co-author papers because they would do all the footnoting and bibliography and formatting and submitting it in and all that kind of. I didn't want to do any of that. But called Zero is the Natural Rate of Interest, and that went into that type of thing. And it's still backwards, which is probably the I think that MMT has broken through on the idea that there's not a solvency problem. Nobody worries about the U.S. going broke, or that deficits are going to per se will drive up interest rates. That it's all up to the Fed. So I think that has gotten through. But what has not is that rate hikes are inflationary and expansionary, and rate cuts are deflationary and contractionary. And then if you go to negative rates like the ECB has done, that's just more contractionary. It's just a big tax. For example, if you have a 1% negative rate, that means if you have €100 at the end of the year, you have 99. I mean, now when Elizabeth Warren wants a 1% wealth tax, for example, on bank deposits, if you have $100 at the end of the year, you have 99. Like, what's the difference? Well, supposedly a wealth tax is a tax which is contractionary, but negative interest rates is easy monetary policy, which is expansionary. Well, it can't be the same thing. Mm-hmm. I mean, it can't be, it's the same thing operationally. You can't have different outcomes. And it's a tax. And the ECB has proven that it hasn't led to any kind of monetary expansion or inflation as feared and hugely feared. So against that backdrop, now we talk about where rates are going to go when those in charge have have the levers backwards, right? Mm-hmm. So from there, let me get specific on your questions now.
I guess, yeah. So with that in mind, just again, I already know what you're going to say, the role played by supply, and not necessarily just the deficit piece, but by QE and, as we had quant tightening. And then the other one was kind of the narrative of there being a safe asset shortage. So you're getting in price insensitive demand. So people want it for regulatory needs or for liability hedging or whatever.
Sure. And that's all true.
Yeah.
So, QE is just a placebo, of course. My first meetings that I remember on that were in the late 90s when Japan was first doing this. And they were doing large size. And I was at the Bank of England with Charles Goodhead had invited me to something else with a guy named Crockett, I believe. And there were two officers from the Bank of Japan there. And we started talking about it because that was the topic of the day. And I said, I don't see what buying JGBs is going to do for bank lending. It's not like the banks have a line of borrowers. If only they had yen to lend. They haven't been restricted in the availability. Loans create deposits anyway. It's not about having. It's not an available funds market or anything like that. It's unlimited liquidity, and so buying JGBs to give them more balances, reserve balances, as Bank of Japan. Why would you expect that to make any difference in lending? And Mr. Crockett, I think it's Andrew Crockett, maybe, he looks over at him and he says, "Yeah, what do you got to say to that?" and because they don't like to ask these questions themselves, they like me to ask them for them. I've noticed that over the years. So he goes, the two guys go, "Well, we believe it's going to do this and give people encouragement. That's our policy, and we'll have to wait and see how it works." So they were very polite about it, and you could tell they weren't particularly convinced either, but they couldn't. It wasn't going to do any harm for sure. So, and that's exactly what's happened. So you've had 30 years of it out of Japan with all the evidence shows it does nothing for anything. It's just a placebo. It's no different than if the government had just issued all 3-month bills and no securities, right? Mm-hmm. Or all 1-week bills, or all just had excess reserves the whole time and not issued any securities at all. It's pretty clear from the evidence that the liability side doesn't, whether the liabilities are in securities or in reserves doesn't make any difference. So, and if you look at asset prices in Japan, they didn't have any explosion of asset prices. Stock market's still, 25% lower than it was back in 1990. And if you look at Europe, after 10 years or more of this now, I've lost track of time, including negative rates, you can't say any of it's caused any kind of credit explosion or borrowing or asset price, bubbles or anything like that. So in the U.S., we certainly haven't seen any effect on inflation or credit explosion. We still have very sluggish credit growth, private sector credit growth. So now we have had what people call asset price inflation. We've had stock market going up, but I have to say it comes from something else. Otherwise, we would have seen it in other countries with the same monetary policies. And so So did I answer your question?
Yeah, no, and this is it's very interesting too, because I think in terms of stuff we're seeing currently, I don't know if you follow a guy named Bill Nelson.
No.
He used to be deputy director of monetary affairs at the FRB, and he's now part of the Bank Policy Institute. So speaking like kind of, as a representative in aggregated banks, and he's been writing stuff on the reserves, actually the high level of reserves actually becoming a hindrance now on bank lending. So kind of going the other way.
Because it uses up their gross leverage.
Yeah, and the SLR ratio,
which is easy enough. I mean, all they have to do is exclude them from the calculation.
Yeah,
it's just a government calculation.
Yeah.
So you have to blame government required calculation for that, not the reserves per se.
Yeah, he's I'll mention it too for Kevin's readers. If people are interested, I think he's a very interesting person to follow. He also talks about stuff like the consolidated borrowing of U.S. government and putting a box around Fed and Treasury and stuff. And so again, another example of, I think, he probably doesn't call himself an MMTer, but been at the Fed representing, or kind of involved heavily in the bank world and saying a lot of similar things you'd hear from the MMT framework.
Yeah. Well, look, for purposes of analysis, that's the type of thing you do with everything. You say, okay, let's look at the country as private sector and public sector. You can't walk out on the street and see a line or anything. It's not like, but you do it because you're trying to illustrate some point. And so to do something to illustrate a point is just a standard analytical tool. It doesn't mean that it's, there's this, line or wall, or there isn't a wall. If you're going to consolidate the Fed and the Treasury, it's not because you're claiming they are one thing. It's because you're trying to make a point about what the government's overall liability is. That's all. Yeah. So, it's like, for anybody to criticize that, it's just totally disingenuous.
Yeah.
And Marco Vla, an economist, did that at one point and then backed off on it, recognizing that it's just foolishness. Yeah.
Fellow Canadian.
Yeah.
Part of the Canadian post-Keynesian crew.
I called them. He's there with Mario Saccareccia and Marco Vla. I call them post-Canadians.
Yeah, it does seem to be a big crew here.
Mario is very, very good, by the way. I like Mario a lot in terms of his analysis.
I actually I wrote a piece for it's called the Canadian Investment Review about a year ago, and it was about endogenous money or the nature of money, and then about a few hours later, I got an email from LP Rochon. He's another post-Keynesian here, and he's saying, one of my colleagues in Ottawa is wondering, where did you learn this stuff? And I knew the colleague in Ottawa was probably Mark Lavoie. And I said, I learned it from Warren Mosler, and then it was kind of like a lighthearted thing about like, we've known Warren for years or whatever, so I talked to him for years. But it's funny because when you start getting in those circles, the world gets smaller and smaller.
Yeah.
It's one thing I find interesting is because, so these kind of like little mini, I guess, I don't know if you want to call it infighting or whatever, but saying it's, there's these disagreements, but compared to the conventional economic framework, there's so much overlap that you're kind of, compared to the convention, there's so much agreement. And I find there's all these little side fights that become kind of a distraction. I didn't follow that one, but or some of the stuff you're talking about where, say like putting the square around the Fed and the Treasury and then really like focusing and nitpicking on that when it's really for an illustrative purpose, and exactly the way Bill Nelson did it. When he talks about it, he's talking about balance sheets, accounting, liabilities, assets. And then these other little arguments or disagreements, they start becoming a real distraction from the big picture.
Look, they were the post-Keynesian group was the endogenous money group, right? Mm-hmm. And I was up there in 1996 or 97. I used to go to conferences, and they talk about that loans create deposits, which incurs a reserve requirement, and then the central bank has to accommodate that, has to add reserves, and otherwise, the system fails. So they don't have a real choice over that. and so money grows endogenously. Well, of course, the mainstream would come back and say, no, you just said they have to add it. If they don't, then it doesn't grow. So it isn't endogenous. It's really up to the monetary authority, the central bank, whether or not they're going to accommodate and add reserves. And if they don't, then they can force the banks to not be able to lend, to not make loans. And the post-Keynes would say, well, it would mean the collapse of the whole system and this and that. And the monetarists would say, well, maybe it would, but they can still do it. Okay. And so I go up there and I say, look, loans create deposits. And then if you incur a reserve requirement in the first instance, that is an overdraft in your reserve account. Okay. The central bank didn't do anything. It's just as a matter of accounting, you are now overdrawn. And an overdraft for accounting purposes is a loan. And in fact, if you leave the overdraft at the end of the statement period, it's booked as a loan by the central bank, and they'll charge you their interest rate on discount loans, whatever it is, maybe a penalty rate or something, but it's a loan with a rate. So loans create deposits and reserves as required, at the same time as a matter of accounting. So it is totally endogenous. Your argument is correct. It's better than you thought it was, because there is no central bank discretion involved. It's just an overdraft is an accounting entry. And so that comes with it. So all three are created by accounting at the same time. Okay, makes sense, right? And here it is supportive of their position, where they've been not winning as they should, not having a convincing argument with the regular mainstream economists. They fought that. They never use it. They never adopt it. They probably still don't. They probably still say the central bank. I don't know. I haven't checked in years. And because it wasn't their idea, I guess, or because it was my idea. I don't know why, but they would never it never factored in. And in fact, a lot of the MMT proponents, when they make their endogenous money argument, they don't use it either. And maybe they don't even know it. I don't know. But, to me, that is like the essence of the endogenous money argument. Mm-hmm. And it's just not there. So it's interesting to what degree it's like the resistance is there, even over accounting.
Yeah. It seems like there's a never-ending flow or points of potential argument or disagreement.
Yeah.
I'd like to switch back to the market stuff. If that's good. Yeah. And I don't know.
Let me say, when I talk to anybody in capital markets and I point that out, they go, "Oh yeah, of course, good, yep, okay, next."
Yeah.
It's like 3 seconds, and it's obvious.
Yeah, and it gets back, I guess, to that stuff we talked about earlier with, when you talk to people in the trenches, or it involves their day to day, and it just seems obvious.
Right.
Just on the market stuff, and I don't know if maybe it's a tough question. Is I guess I'm thinking of, say, the Italy example in your trade at that time, where I guess you saw a real opportunity, and I don't know if I'm putting words in your mouth, but where maybe it seemed like an obvious one at that time to you, given your perspective. I'm curious if you see any other current ones. And I guess what I'm thinking, and maybe it's not relevant because, as you talked about earlier, when it comes to the potential for U.S. default, it's not necessarily the ability to pay, it's the willingness to pay. But I go back to, it was the first MMT conference a few years ago in Kansas, and you were there, or you were in the front row, and you had some good kind of comments and jokes during the presentations. And one of them was Glenn Haddon. He used to be head of rates and FX at Morgan Stanley. And I remember they introduced him as the person that's traded most dollar value of treasuries in history. So, clearly someone that has been involved in this stuff quite heavily. And he was presenting basically an MMT view. And at the time in the presentation, I remember he said he was talking about U.S. sovereign CDS. And he said, there's never been a more useless financial product than this. And, everyone laughed, just given the crowd. And so, maybe I remember him saying there is reasons for it to exist, and he can get into it later, and he never did. But it's I think of that.
See, I think I had recommended to the Fed that they sell CDS, for a nickel or something, because there's no risk to them, of course. Mm-hmm. And because some people are required to hedge against it, fine, let them pay the Fed, if that's what their investors want.
Mm-hmm.
So, but when you let it go in the marketplace and these guys have to buy CDS and they run the price up, it just makes the government look bad. It's a destabilizing thing for the system, and there's no reason the Fed just can't sell unlimited amounts at 5 cents or whatever.
Mm-hmm. So I guess I'm thinking, not necessarily a specific trade around that or something, but where it's something that's just generally, I think, misunderstood in the broader community. Like, is there anything out there today that you see that's just really misunderstood and creates possibly an opportunity?
There was. I don't know if it's still there because I haven't done this in a while, and maybe somebody's already doing it. But you've got equity indexes out there, such as in India, on their futures market,
mm-hmm.
and it represents the rupiah price for all the stocks, and it's like 54,000 or something is where the index is. But if you buy the futures market and it goes up or down, you get paid in dollars at a fixed rate, say $25 for basis point or $10 a basis point, whatever it is. Now, if they didn't do that, if they just paid out in rupiah, and I went to Morgan Stanley or JP Morgan or Deutsche Bank, any derivatives trader, and I said, look, I want to buy this futures exchange, but I want my profit swapped to dollars. Okay, that's an expensive hedge. It's not going to cost you nothing. It's going to be but the futures contract is giving it to you for free. Therefore, the futures should trade at a premium over the cash to reflect that. And when I checked, it was trading even with the cash.
Mm-hmm.
And so I don't have a firm anymore. I can't do this type of thing anymore. That's the kind of thing I would have looked into
mm-hmm.
to see, what's going on. Is there a way? Should I be buying futures and selling cash here? To benefit from that,
mm-hmm.
from this pricing.
So just when you're saying, you're not directly involved with the firm anymore and stuff, are you, I presume you're still following markets closely?
Not like I used to. I'm more of a headline follower now. I'm not, I don't spend the time to dig into it anymore.
Uh-huh. Okay.
But, something like that, when I see that strikes me as, okay, major opportunity here for somebody who can dig into
mm-hmm.
this.
Mm-hmm.
Okay. Now, maybe somebody already has, and maybe it's trading at a premium now. I don't know.
Mm-hmm.
But last I checked, it wasn't at all. It was trading equal to the cash. And it's not just that one. There was another market where the same thing was happening. I don't remember which it was. And they changed, the exchange changed it, so.
Mm-hmm. What's it in the U.S. Virgin Islands? Are you seeing kind of direct impacts already in terms of, the marine?
Well, I guess the hurricanes, we'll see. I don't think the storms so far can be used as examples because 100-year storm just means it happens every 100 years. That's the norm. And I saw some climate people, rightly so, cautioning against using, local weather as indications of climate change rather than just the normal pattern, 100-year pattern, 500-year pattern, whatever it is. And, but that would be what would happen here. It would be
mm-hmm.
the intensity and severity of storms. I don't think the temperature difference is going to make much difference because it's pretty steady down here anyway. Maybe you lose some coral reefs or something like that, which is tragic, but I don't know. I think I'm at 70 feet of elevation, so I'm not worried about flooding for my house, but we could have all the coastal areas flood, of course. And Florida, same thing. But again, that's what they're going to have to deal with is flooding coastal areas. We're not going to stop it. Whatever these ramifications are going to be, I think they're going to be, and we're not going to stop it, at least not for a long, long time.
Mm-hmm.
To reverse it would just take even if you went to zero emissions, would take 20, 30, 50 years to reverse what we've already got in place, happening in place right now. The dynamics are already there.
Is there any relation? I want to bring up your ventures into the catamaran building world. And I know that I think, so just to summarize, my understanding is you had designed a new, came up with a new design for a catamaran that handles rough waters better. So I guess I'm wondering,
it's a tandem design. Mm-hmm. is more appropriate because it could be a tandem monohull or tandem catamaran. And I built a tandem catamaran ferry down here. It's just 2 hulls way out in front and 2 hulls in the back. It's like 2 catamarans separated by a bridge. So the first front catamaran is like, the hulls are 40 feet long, and the back ones, the aft hulls are 50 feet, and they're separated by a bridge, and the overall length of the boat is 100 feet. But what it does is it gives it the effect of a long wheelbase ride rather than a zero wheelbase ride. And I don't know how much detail you want me to go into.
No,
there are no moving parts or anything. It's like a truck versus a bulldozer, or a truck versus a tank. Bulldozer or tank, if you try and drive it more than 30 miles an hour, you're just bouncing along over bumps and flying in the air and all that, which is and pitching front to back, which is exactly what a boat does. Mm-hmm. A boat is a zero wheelbase thing where when you go over a wave, the wave's over the front, then it's the front's over the wave, then the middle gets lifted up, and then the back gets lifted up. Mm-hmm. And so it's constantly climbing up the wave. The whole thing's going over it and then going down, as opposed to a bicycle going over a bump. The front goes over, then there's a little bit of a space, and then the back goes over. Or a car going over a bump, front wheels go, then the back wheels go. Mm-hmm. But if you're on a toboggan, the whole thing has to go up and over. Or if you're on skis, the whole thing has to go up and over. Okay, so with a boat, a normal boat is the whole thing going up and over the wave. But when you have 2 hulls way out front and 2 hulls in the back with a big space in between them, then the front goes up and down a little bit of time, then the back goes up and down. And it just changes all the accelerations, and it still moves around, but it's not the accelerations that make people seasick. So it's a much, much nicer ride. And the ferry's been running for 3 years, taking people going back and forth. Mm-hmm. It's worked out well. But it's not a business, that I'm not in the boat building business or anything like that. It's just something I did to promote inter-island travel, ferry travel. It makes a little bit of money, not much. And I use it for my personal boats. If I go out fishing or go out for a ride, I have hull. That's how the hulls are on my boats, and so I, don't get my passengers don't get seasick or anything like that, like other boats do.
Yeah, I guess I was wondering about it, whether it was a response to the storms, rougher water, because I know it. And then
it's always been like a washing machine going between islands here.
Yeah, okay.
And people just get violently ill on these other ferries, and so I came up with this thing, and people like it and they ride it.
Yeah. And I also wanted to bring it up so Kevin's listeners can, if they haven't gathered already, just seeing how interesting of a character you are with the trading and the analysis and the entrepreneurship. And I think MMT often gets labeled with this, big government and anti-business or whatever kind of label. And, if the godfather of MMT is not just a hedge fund founder and trader, but also entrepreneur, and clearly sees the role for innovation. It really goes against a lot of those kind of, I guess I can call them stereotypes. And there's also the, in addition to the catamaran, I'm going to mention here too, for people that don't know, Warren also started his own car company. And I think if I have it right, it was the fastest production car in the world.
Well, it's still the top. It still is the top performance car in the world. A couple of people dusted off, a couple of them last year. Well, maybe probably the year before now, and won the Spanish GT series with them. Wow. 20-year-old cars against new cars. So, it was, and I believe still is the top performance car in the world.
Yeah.
Now, I don't. Not to say some 1,000 horsepower. 2,000 horsepower Tesla can't beat it in a drag race, with 4-wheel drive or whatever. But the cars were last built in 2012, I think. Mm-hmm. So I sold the company in 2013, and they haven't built any since.
No, okay. I recall stories from one of my previous employers, and it was people there, I guess, dealt with AVM, and there was a annual conference down in Florida. I didn't attend, but I remember hearing two stories that stand out to me about that. One was you would leave the car or a car outside with keys in it and welcome anyone to try it at any time they pleased. I don't know if that's true or not. And the other one I heard was someone was down there, and you were there at the time as well, and it was during one of the presidential campaigns, and they were watching the campaign with you and Obama or someone saying, we all have to tighten our belts or something along those lines, and then being able to watch that with you and see your response was apparently quite an experience for them. So those are two things that stand out about that.
Probably true about the car.
Yeah. Okay. So I guess bring it back to kind of more, I guess, economic market stuff and MMT related, because these are a couple of questions I really wanted to get to, and then I guess we could wrap it up and let you get out on those waters. So one is, I guess, because I a lot of my own ideas are MMT consistent, or I view the world through an MMT lens. These are questions I often get or push back. So I'm curious to hear what you would say about some of them. One we already talked about earlier with the idea of rate hikes being stimulative. So I think we've already talked about that one. But one I'm curious about is the sectoral balances. And I don't know if it's an MMT specific thing, but just viewing the world, breaking it up into the three sectors of government, private, domestic, and rest of world. And looking at the net balances across the three groups and over a given time period. One thing I'm wondering about, and it's a question I've gotten, I wonder about myself, is if you see added value in expanding it to 4 sectors. And by that, I'm thinking specifically about taking the private sector, instead of lumping it into just one whole one, breaking it out into business versus households, and then getting an idea of the dynamic there. And I guess what I'm thinking there is just to allow for kind of more analysis or more kind of color on what's happening, say, within the business sector itself. And I think for the purposes of illustration, that the 3-sector model is very helpful in getting the point across about the government deficit being everyone else's savings, net savings. I'm just wondering if you ever go down into that kind of 4th sector, to dig a bit deeper into the household versus corporate sector dynamic.
Yeah. Well, if you go back to soft currency economics, and which is probably the first thing I wrote down, I use just 2 sectors, government and non-government. And I didn't see any particular reason to divide the non-government sector into residents and non-residents, which is what the foreign sector is, unless there was some question that needed to be answered. Okay, about that. So I start with the 2 sectors because, to me, that was what was answering the questions I was asking or wanted to know about in soft currency economics. And then in other papers after that, those were generally the questions I was trying to answer. When there were foreign exchange, when there were questions with the foreign sector, then I would divide to answer those questions, and I would divide the non-government sector into residents and non-residents, which is what the foreign sector is. They're people dealing in U.S. dollars that don't happen to live here, and you would. It's about their U.S. dollar dealings, their accounts at either U.S. banks or U.S. member banks or something like that, and there's dollars that shift, quote, go overseas or shift between countries. Under close examination are dollars that are moving from one account at Citibank to another. They're moving from a residence account to a non-residence account at Citibank. They just happen to be, the account holders happen to be living in different places. So those are the sectors that I use to answer most questions. Now, if you came up with another question about households or businesses, then I might see the value in dividing that non-government sector into businesses versus households. And if it mattered whether the businesses were residents or non-residents, then I could, further divide it as into residents and non-residences. So you follow what I'm saying here? Yeah. So I don't just start off with something more complicated than it needs to be. And so I see the need to answer questions, and it needed to be 2 sectors. So that's what I did.
Mm-hmm.
And until somebody, I'm not going to answer the question nobody's asking, so to speak. Particularly I'm not asking the question either. So I can't think of anything I've written that divided it into more than two sectors, or needed to divide it in more than two sectors. And I have used residents versus non-residents to answer questions, particularly on capital flight and that type of thing, which, it's very illustrative for that, to answer questions on those issues.
Yeah.
So if you give me the question you want answered, then I can tell you how I would divide up the sectors.
Yeah. And again, from personal experience, because a lot of these concepts are new or different for people, the more potential questions you add and layer in makes it even harder to get the concepts across, I find. So
yes.
just keep based on what you're trying to get across, and just keeping it to the simplest as possible, I think is
Now, Wayne Godel used to use 3-sector analysis to answer his questions, which were about forecasting.
Mm-hmm.
And so that, he found that helpful. And he included state and local governments in the government sector, which he found helpful. So he looked at those as well, which is all good. That's what he did. And so I think a lot of the academics who knew him and knew of him read his work, and so they started doing the same thing, just kind of automatically, rather than tailoring it to any given question.
Mm-hmm. Okay. And another question on the international piece.
Yeah.
I'm curious what you think about when it comes to defining a currency issuer versus a currency user.
Yeah.
And thinking about countries, I guess particularly potentially EMs, but it could be anyone, where they do issue in a local currency.
Mm-hmm.
So they're an issuer when it comes to debt and, issuing in your own currency.
Yeah.
But if at the same time they are reliant on a lot of, imports for particularly essential supplies, so food, energy is what I'm thinking. And then to the extent those are priced in US dollars, so that now, even though they don't need to get dollars for the purposes of servicing debt, they do need to get dollars in order to keep their citizens happy. Would you consider those to be currency issuers still?
Yes.
Yeah.
Okay. And they're making choices. And a lot of those conditions you talk about are okay to talk about in terms of asking a question, but when I ask for specifics, they don't seem to have any. So, for example, a friend of mine was saying something like that. So, give me a specific. He says, "Well, if you buy gasoline in sub-Saharan Africa or something like that," he named some country, and I go on the internet and look up gasoline station in whatever country it was, and there's a gas station priced with a big sign, and the price is in the local currency. And I send it to him. Mm-hmm. He goes, okay. I get your point. So if you say, this country is importing whatever, and they're priced in dollars, but you go to the grocery store they're priced in local currency. And the government's not doing the importing. Mm-hmm. So what's going on? The people living there don't pay in dollars. What you're saying is if the world price changes, or if their currency changes, whatever, the relative value changes, their prices can go up. Mm-hmm. So they're subject to fluctuating food prices because they're importing food. And that's correct. It's the same thing in the U.S. If we're importing steel or something like that, or oil, and then the price of Saudis raise the price of oil, we pay more for oil. And so what about it? Does that mean we should issue, debt in some foreign currency, Saudi Arabia's currency, because of that? I don't connect those dots. Mm-hmm. I see things we can do, but to me, that doesn't connect the dots towards foreign debt. But if we did, fine. You can go to a country like Argentina, which has enough foreign debt to consider defaulting periodically, mm-hmm. however much that takes. Does that mean what? They still have the peso. They still run most of the government in pesos. They can certainly sustain full employment because you got all these people who are unemployed looking to work for pesos. There's no operational limit from the government hiring them. Mm-hmm. Yes, they might start importing. They might buy imports, which would change the distribution of imports in the country. Might cause the peso to go down and make imports a little more expensive so that they could afford some and other people couldn't. So yes, you could change the distribution of consumption within the country, but it's not going to change the real terms of trade. It's not going to change um, the real wealth of the country. I mean, for the worse, it's going to go up.
Mm-hmm.
And so, the macro picture is that the real wealth of any country is equal to everything they can produce domestically. It's kind of like your pile of stuff, which is larger if you got more people working and more people producing. So you want to sustain full employment to optimize your pile of stuff. Plus, all your imports add to your pile of stuff. And then all your exports subtract from your pile of stuff. And so to optimize your real wealth, you want as big a pile as possible.
Mm-hmm.
Domestic production plus imports minus exports. Get your pile, and those used to be called real terms of trade to try and optimize your real wealth. And that's all mainstream, and that all still holds 100%. Now, if the currency goes down because of it or whatever, it's going to change the distribution of that real wealth, but not the total. And so distributional issues are all determined by domestic fiscal policy. Who gets taxed, who gets the benefits of spending, those are all the distributional issues. How much Social Security gets paid. And these are all determined all the time. The minimum wage, there's all kinds of, pretty much everything that the government does is distributional. And so my question is, okay, so let's say you've got some issue with your currency's depreciated and you've got inflation or something like that. Is the answer to lower your real wealth by lowering your domestic output in an attempt to address your distributional issues? That is, do you want to make yourself poorer in real terms to address your distributional issues? And to me, that doesn't make any sense. You want to keep the wealth in real terms, total wealth, real wealth, and then adjust the distribution of that highest possible amount of real wealth, right?
Mm-hmm.
So looking at it through that lens, you come up with very different answers than what you hear from any of the international agencies or any of the mainstream economists.
Yeah.
I think you come up with much better answers and much more constructive answers for the population. However, that constructive answers for the population is generally not the criteria for policy. What we find in the world a lot is that the exporters get in control, and it's what's a constructive outcome for exporters, not for anybody else.
Mm-hmm.
And that seems to become policy in most of these countries,
mm-hmm.
which
Okay.
is sort of a form of corruption, right? It's not legal corruption, but it's certainly not. It's not there for the benefit of the majority of the population.
Mm-hmm. This is great hearing this stuff because, like I said, I'm asking for selfish reasons sometimes too, because this is stuff people ask me, or I hear. So the more I hear from you on this stuff, the more it's very helpful for me too. So I appreciate this.
Sure.
And I guess this segues nicely to the idea of fiscal policy being used to address domestic goals. My sense is, and kind of just looking more to the future here, it does feel like recently we're, with the attention MMT is getting, the policy response to COVID, these things are kind of aligning to potentially point to a structural shift in the way policy is done, particularly, greater emphasis on fiscal, less sole reliance on monetary.
Right.
Are you hopeful? Do you think that is the case? Or do you think the same old austerity fears are going to creep in? It's just a matter of time.
I think I'm hopeful it is the case. And I have to thank all the MMT proponents out there who've got us to that point. If it was at one point, it was just me and I'm not motivating any of these people. They're all doing it on their own. People like yourself, you're out there doing this. And it's gotten us to that point where they're not worried about solvency. We spent, $5 trillion in the U.S. without even discussing a tax. So they understand they can do that. The remaining restriction now is that we're seeing signs of inflation. We better back off, because if we get inflation, then we have to raise rates to fight it. Now, if we understood that if we get inflation, you don't raise rates to fight it. If anything, you lower rates, but we're already at zero. So you do something else. Then we'd be okay. But this whole idea that we have to raise rates to fight inflation has, some, can go very bad as it's done in the past, because you start raising rates, which creates more inflation. So you raise rates more, and you keep doing this until the inflation itself causes a fiscal contraction in a couple of ways, because you get bracket creep and incomes go up, and so tax rates go up, and so revenues start going up much faster than spending, and this happened in 1979. But also, the amount of net financial assets in the society, the public debt, is there because it's desired in real terms. People desire a certain amount of savings for what it can buy. You need to have $1 million to feel safe about your retirement, because if you can earn 5%, you can live on $50,000 a year or something because of what $50,000 buys. You suddenly have a big inflation, now that $1 million isn't enough. Okay, if you've got $1,000 in every cash register in your store, prices go way up, all of a sudden to make change and everything else, you need $2,000. So inflation causes the desire for the transactional money supply in the economy, the net savings in the economy, to be a lot higher. In other words, it creates, the public debt becomes too small because of inflation. If prices doubled and the public debt stays the same in nominal terms, now in terms of percentage of GDP, it's dropped way down, right? And so now it's contractionary. Now you don't have enough equity to support the credit structure, and you get a really bad recession and it caves in. So the high rates promote inflation, which promotes a decline in the growth of the real public debt, which triggers a fiscal contraction. Mm-hmm. And that's what happened in 1979. The inflation was severe. The public debt as a percentage of, in real terms, was shrinking, which is, like running a surplus, right? If you didn't have any inflation, you would have to run a surplus for the same effect. And it just triggered a horrendous recession. And so and I think if you look back, most of the recessions came about with similar dynamics. And so the one risk now is that because we've got the interest rate thing backwards, we could get into that dynamic again of inflation equals higher rates from the Fed equals more inflation, and the whole process is contracting fiscal policy until it breaks. Mm-hmm. So, I'm concerned about that dynamic, but it's pretty far down the road right now. Mm-hmm. And 0.5% in rates 2 years from now is not going to do it. Yeah. So, but just the idea that the fear of the Fed hiking rates as the only source of stopping runaway inflation, because if they don't, we'll turn into Zimbabwe or something, is what's, I see as the remaining source of, gross instability in the system.
Yeah. Okay. Well, I guess that sounds fairly hopeful. That there is some change, and my sense too is that it seems like more than ever, central bankers themselves are bringing up the fiscal lever more and more, which I think is positive as well. So
yes.
I guess it's always good to end on a positive note, and we're up around that 2 hour mark, which I think is quite long. Okay. Ideally, we'd be able to talk in person, maybe again in the future.
Sure.
And hopefully, Kevin's not on vacation, and we could all meet in person and go even another 2 or 4 or 6 hours. So, okay. I always appreciate your thoughts, Warren, and it's been great catching up, and I hope everything's good with you and the family, and we'll talk again soon.
Very good, and the best to your family as well.
Great. Thank you very much.
Thanks. Yeah. Take care.
That does it for this week's special episode, and we'll be back to our normal show format after Labor Day.
We hope all you huddlers have a great and wonderful summer. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna. Kev, where can they find you?
On Twitter, I'm there at Kevin Muir, and you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in.